Welcome to this lecture video. In this lecture video, we are going to look at discussing illustration 5. We'll discuss illustration 5, and illustration 5, after discussion, will give you time to go sit down and try and attempt it, right? Any clue that you need to be able to solve illustration 5, you'll be given. And so please try example 2.5 on your own. The clue is that the intra-group adjustment is just like simple consolidation. Apply the burnout rule and you will be okay with the test. Feel free to revise simple group if need be. Your issues will be addressed in the live section, but you shouldn't have any issue because the question is very simple. We have the financial statement of antelope, young, and zebra as at first number 20x4 are summarized as follows. We have the assets, we have the freehold property, we have the plants, and we have the investment. So the investment, we have investment that the parent has in the subsidiary, and the investment that the subsidiary has in the sub-subsidiary, right? Okay. So please note that so far, all the illustration that we've looked at from illustration 1 to 4, we have ignored the issues of intra-group trading, we have ignored the issues of fair value adjustment, we have ignored the issues of fair value of purchase consideration, we have ignored the issues of fair value of purchase consideration that includes deferred consideration, contingent consideration, share for share exchange. We have ignored all these things. But please note that as it applies in the days of simple console, it's the same, or it can be applicable to the complex group, and the treatment is the same. It's much the same. If there are any fair value adjustment, the way we will do it in workings 2 to adjust our net assets of any fair value adjustment, the double entries, it's the same thing. So if you have any issue, just go back to the simple console, revise all the intra-group transactions and adjustments. Because here, believe me, you will not have to waste our time going to revise. Oh no, please. The videos are there. You have to do that for yourself. If you have any issue, we are still available to support you. Okay, so we have inventory, we have receivable, we have cash, we have equity, we have retained earnings. Then we come to the note said Antelope Company acquired the 75% of the shares of Young in 20x1 when the credit balance on the retained earnings of that company was 40,000. No dividend had been paid since that date. Young Company acquired 80% of the shares in Zebra in 20x3. Right, so here it means it was a parent and a subsidiary, so Antelope and Young. Then Young going to acquire Zebra, okay? Acquired Zebra in 20x3 when there was a debit balance on the retained earnings of that company of 3,000. So retained earnings should have should have a credit balance, but in the retained earnings of Zebra, it's a debit balance. That was a retained loss, right? You have to indicate that when you are doing your group retained earnings, your assets, your working stew, the retained earnings as at the acquisition date for Zebra will be in brackets, right? Will be in brackets because that retained earnings, that working stew is about the equity side of the accounting equation. So equity items should have credit balances, but if the equity item, which is the retained earnings, has a debit balance, right, indicating what a loss, a retained loss, you have to show it in brackets. Okay, that's the only new thing issue that it doesn't mean that it is difficult. No. Subsequently, $5,000 was received by Zebra Company and credited to its retained earnings. And subsequently, 5,000 was received by Zebra and credited to its retained earnings, representing the recovery of an earned recoverable debt written off before the acquisition of Zebra. So you can treat the debit retained earnings, right, of Zebra separately from the bad debt recovered, or you can adjust the bad debt recovered on the retained earnings of Zebra, because we are told that subsequently $500 was received by Zebra and credited to each retained earnings, right, and credited to each retained what earnings. How do you get it? So bad debt recovered, the double entry is it's a bad debt that was written off. So you credit the the income, right, and you debit cash, right. So you credit the income and you credit cash. The example is 100 Ghana cedis was received by Zebra and credited to each retained earnings. Right, so we have to credit this to each retained earnings. So it's either you treat it separately or you treat it as one. Already they have a credit balance of 3,000. Yeah, so 3,000 debit balance of 3,000. So roughly the debit balance reduces what to 2,500. Okay, reduces to 2,500. Okay. During the year to 31st March 2024, Young purchased inventory from Antelope for $20,000, with which include a profit markup of 4,000 for Antelope. At 31st March 2024, one half of this amount was still held in inventory of Young Company. Group accounting policies are to make a full allowance for unrealized intra-group profit. So, uh, one half of the amount of this was still held in inventory. So, you have to determine PRP. The determination of PRP is the same as simple group. This one is not complex, so you have to revise how to determine your PRP. If there's any issue, go back to the lecture videos on simple console. Okay. So we are supposed to prepare non-controlling interest is on the net asset method, right? Net asset method. So the NCI is on net asset method. So very simple. The only new thing that will probably baffle your mind is the retained earnings being debit at the acquisition. Usually we see the retained earnings being what positive or being credit, but in the issue of Zebra, the retained earnings was debit. You should know accountants. You are not doing robot accounting. It is equity. We are purchasing the net asset using the equity side. So all the equity balances should be positive. But if the equity balance is negative, that means it's showing what a return loss. Right. Okay. So that's it. Attempt this question. Take your time, attempt it. Then we'll have a discussion on it during the live section. Thank you very much. Bye bye.